So here's what's wild right now. You've got the Dow Jones up 3.2% this month. You've got the S&P 500 basically flat, down just 0.1%. But Bitcoin down 15.9%. Gold down 10.2%. And if you're watching the financial news, you're seeing headlines about oil prices falling, markets soaring, and some kind of historic US-Iran framework deal. This is confusing as hell if you don't know what's actually happening under the surface. By the end of this video, you're going to understand exactly why the market is moving the way it is, and more importantly, what you should actually be doing with your money right now. Let's start with the thing that's been dominating financial news this week, the geopolitical shift. On June 12th, we got confirmation that the US and Iran announced a framework to reopen the Strait of Hormuz and end their ongoing conflict. If you don't follow global economics closely, that might sound like, okay, cool, less conflict. But here's why Wall Street absolutely loved it. The Strait of Hormuz is one of the most critical oil choke points in the world. About 20% of global oil passes through there. When there's tension in that region, oil prices spike, supply chains get disrupted, and inflation concerns come roaring back. So when the market heard that there's now a framework to de-escalate, oil prices tanked immediately. WTI crude fell hard. And when oil prices fall, suddenly energy stocks become less valuable, but manufacturing costs go down, supply chains become more efficient, and consumer goods become cheaper. That's why you're seeing the broader market rally right now, especially the Dow, which is loaded with industrial and consumer discretionary stocks that benefit from lower energy costs. But there's another reason the Dow is outperforming right now, and it's actually kind of surprising. SpaceX went public on June 12th. This isn't a small thing. SpaceX going public is a huge deal because it represents a shift in how institutional investors are allocating capital. You're seeing funds rotate into space economy plays, aerospace contractors, and anything tangentially connected to commercial space. That event alone triggered a rally in the industrials and defense sectors, which have a massive weighting in the Dow Jones. When you combine the Iran deal de-risking energy prices with SpaceX's IPO excitement, you get the kind of day that pushes the Dow up 3.2% for the month. It's not a broad market rally. The Nasdaq is only up 0.9%. The S&P is basically flat. This is a very specific rally driven by very specific events. Now let's talk about what's happening with Bitcoin and gold, because this is actually the most important signal in the market right now. Bitcoin is down 15.9% this month. Gold is down 10.2%. And here's why. When geopolitical risk decreases, when the Fed signals stability, and when people believe we're moving toward normal economic growth, they stop buying defensive assets. Bitcoin and gold are essentially insurance policies. You buy them when you're worried about currency collapse, inflation spiraling out of control, or the world falling apart. But if the Iran situation is resolved, if supply chains are normalizing, and if we're getting more clarity on inflation, then people say, okay, I don't need as much insurance. They sell their gold and Bitcoin and rotate into growth stocks and dividend-paying equities. That's exactly what we're seeing right now. The other thing driving this rotation is what the Fed is about to do. We know from recent reports that the Fed is likely to keep interest rates flat for the immediate future. This is actually important context. Last year and early this year, the Fed was keeping rates elevated to fight inflation. But with supply chains normalizing, the Iran conflict de-escalating, and oil prices falling, inflation pressure is actually easing. So the Fed can afford to hold steady rather than cut aggressively. When the Fed holds rates flat instead of cutting, that actually reduces the appeal of gold as an inflation hedge. You're not getting paid much to hold cash or bonds, sure, but you're also not in a crisis scenario anymore. So gold loses some of its appeal. Bitcoin loses its hedge against fiat currency collapse narrative. And regular stocks look more attractive on a risk-adjusted basis. Here's the thing nobody is talking about enough, though. Morgan Stanley just put out a report called "The Rally is Back, but Risks Are Rising." And they're right. Yes, we're having a nice rally right now. The geopolitical winds are at our backs. Energy costs are falling. SpaceX going public is creating optimism about innovation and growth. But risks are absolutely rising in the second half of 2026. You've got potential Fed policy mistakes. You've got the fact that valuations in certain sectors are getting stretched. You've got the reality that corporate earnings growth is slowing. And you've got this broader trend that the New York Times just documented. Americans aren't getting more financially savvy. They're actually getting worse at managing money. Meanwhile, younger generations are rejecting the traditional American dream of a house and retirement savings, which could have huge implications for the housing market and consumer spending patterns. So, what does this actually mean for your portfolio right now in June 2026? First, understand that the current rally is sector specific and sentiment driven, not fundamentals driven. The Dow is up, but that's because of energy, industrials, and defense. Technology is lagging. If you're holding a broad market index fund like VOO or VTI, you're getting a blended return that doesn't reflect the real market story. Second, the rotation out of Bitcoin and gold doesn't mean those assets are going to zero. It just means that right now, in this specific moment, capital is moving elsewhere. But if we see another geopolitical crisis or if inflation picks back up, that can reverse quickly. Third, keep in mind that just because oil prices are falling and markets are rallying doesn't mean consumer prices are falling. There's always a lag between commodity prices and what you pay at the pump or the grocery store. Here's my specific action plan for you right now. Number 1. If you've been sitting on the sidelines in cash or money market funds earning about 4.5% right now, this is actually a decent time to start deploying some of that capital. Not all of it, because we're in the middle of a potentially volatile period, but dollar cost averaging into a broad market index fund over the next 3 to 6 months makes sense. You get to benefit from any further upside while protecting yourself if there's a pullback. Number 2, take a hard look at your sector allocation. Are you overweight energy because you thought oil was going to the moon? Now might be the time to trim that. Are you underweight industrials? They're on a run right now. And if the global economy is actually normalizing, industrials could have more upside. Number 3, don't panic sell your Bitcoin or gold just because they're down. The reason they're down is actually good news, geopolitically speaking. If you have a strategic allocation to these assets, hold them. They're not insurance you cash in on a sunny day. You hold them for the rainy days. Number 4, and this is important, pay attention to what the Fed actually does at their next decision. If they cut rates aggressively, that's a signal that they're worried about something we don't know about yet. That would be a red flag. If they hold rates flat like expected, that's a sign they're confident in the economy. If they hike even slightly, that would be shocking but would suggest they're seeing inflation re-accelerate. Your portfolio strategy should flex based on what actually happens, not what you predict will happen. And number 5, start thinking about tax optimization for the end of the year. We're halfway through 2026 now. If you've had gains in certain positions or losses in others, start planning your tax strategy now rather than scrambling in December. If you're using platforms like Schwab, Fidelity, or Vanguard, all of them have tax loss harvesting tools built in that can help you optimize your situation automatically. The bottom line is this: the stock market is doing what it's doing right now because of very specific real-world events that are actually pretty positive when you understand them. The Iran deal, SpaceX going public, energy prices falling. These are real things that impact real economic activity. But they don't mean the market is now risk-free. They don't mean you should suddenly go all in on stocks. They mean you should be thoughtful, diversified, and ready to adjust as the situation evolves. The traders and institutions are rotating capital right now because they're reading the signals. You should be doing the same thing, just at a pace and with a strategy that actually matches your time horizon and risk tolerance. If this breakdown of what's happening in the market right now is helpful to you, please hit that subscribe button, because we're putting out new market analysis every single week. Comment down below which sector you think is going to outperform in the second half of 2026. Are you betting on industrials, tech, energy, or something else? And if you want me to do a deep dive on any of these topics, whether it's the Iran deal's impact on energy stocks, or how to rebalance your portfolio, or whether you should be buying Bitcoin and gold right now, let me know in the comments. We read every single one of them, and your questions become our next videos. Thanks for watching, and I'll see you in the next one.